Did you know there's a strategy that can triple your returns while using 1/3 of the risk and capital? I'm going to be teaching you guys how to trade the deep in the money call options. By the end of this lesson, you'll be able to trade this powerful strategy and save thousands of dollars right away. I'm going to be going over the benefits of the strategy, how this option trade works, and how to trade it with some live examples. Let's talk about the benefits of these deep in the money calls. When comparing to buying stocks outright, you will be using 3 times less capital, and also you will be risking 3 times less. And at the same time, you will be amplifying your returns 3 times. This is truly a low risk, high leverage strategy. It is risk defined, so we won't be using any margin. So it can be used in Roth or TFSA accounts if you're in Canada, or any registered accounts. So what is deep in the money call option? By the way, going forward in the slides, I'm going to be using the acronym DITM calls. It is a long call option that is far dated, 1 to 2 years out. We're going to be looking at 90 plus delta. You can go 95 if you want, but I find 90 is the sweet spot. It's a good balance of the premium pricing and delta. Okay. At 90 delta, these calls have very low extrinsic value. In other words, it has very low premium cost to it. And also, the theta decay is fairly low. We'll look at the numbers later on in this video. When should you use it? This is a long call option strategy, so it is a bullish strategy. We want to be using it when we believe the instrument, the underlying, is going up. This is also a swing trading strategy or a long-term hold strategy. So you're generally looking to hold this for months or maybe a year or even 2 years. It is not designed for day trading. It is also not good for scalping or any few days hold. So when you trade this strategy, you still need to follow risk management, just like how you would long a stock or any ETF. Okay, I'm not gonna go into any risk management strategy here, but it wouldn't be any different from your typical long position. So you might use some technical analysis such as support and resistance zones. So if it hits your support, maybe you get out. Or you can have a set amount of money to lose. For example, 2% of your net lick. The bottom line is you still need to have some exit strategy. And it's no different than going long using shares. How do we manage this strategy, this DITM call? When the expiry is approaching 90 days, the theta decay speeds up. What you can do is you can roll it out in time. So what you would do is you'll sell your current call option and buy one that is 12 months or 24 months out in time. The second thing you can do is, okay, now you made a good profit and you want to take profits. You can exercise your option. However, note that if you exercise your option, you will give up some extrinsic value. So for that reason, I personally do not exercise my long call options. I rather just do the third option, which is sell the call option. This is the easiest and cleanest way to exit. I personally use this the most. I use it to take profits, and also when I get stopped out, I just sell the call option. So let's look at some numbers, some calculations. Let's talk about the break-even point of the strategy. If your stock is $100 right now, and this call option costed you $10, so at expiry, when you have 0 days left, the stock has to be $110 for you to break even. The break-even point is simply the stock price plus the premiums paid. In this case, 100 plus 10. The max risk of this strategy is the cost of the call. So this is a debit trade. You have to pay to open this trade. It is a defined risk trade. You cannot lose more than what you paid, and there's no margin usage. Let's look at some numbers. XLV, the current price is $158. So if you were to buy 100 shares of this, it will cost you $15,800. If you were buying the DITM 90 Delta call, it will cost you $4,100. Let's do some analysis. I made an Excel sheet right here to show the difference between the stock P&L and the call P&L as the stock goes down. So when the call expires and the stock didn't move at all, 0% stock movement, remains same at 158, we actually will lose a little bit of money. 214 bucks to be exact, because the premium that we paid when we first bought the call was 214. Now, let's look at what happens when the stock moves down 25%. The calculations for the stock P&L is very simple. We spent $16K to open the 100 share position, so our P&L will go down by about 25% if the stock goes down, so $4K in that case. At 50%, we'll lose half of our investment, so about $8K. And the worst case scenario, if the stock goes down to zero, we're gonna lose our full $16K investment. Let's look at the call side. When the stock goes down 25%, it's pretty similar. We lose about 4K-ish here, a little bit less than that. At 50% and 75% and 100%, you can see that the numbers don't change. Why? Because to open this call, we paid $4,100. We cannot lose any more than $4,100. So that's why this is a risk-defined trade. And our max loss is capped. You can see at 100% loss, in the worst case scenario, we are losing 4 times less money than if we were to hold the shares. This is what makes this strategy very powerful and very risk efficient. This is especially useful if you like to play dangerous stocks, a lot of Wall Street bet stocks. Not saying you should play those stocks, but if you had to, this is a very good strategy to manage your risk and to control your max loss. Now let's look at when the stock goes up. When the stock goes up 25%, you'll make $4,000, 50% you'll make $8,000, then $12,000, and then $16,000. If the stock doubles, you'll double your money. Very simple calculation. If the price stays the same, you actually lose some money. You lose the premiums you paid. Let's look at this side. You will notice the call always makes a little bit less money than the stock side. Why? Because you paid premiums. So that's something you'll never get back. Second, it is a 90 delta call. So when the stock goes up $1, your call only goes up 90 cents instead of 1. The stock is 100 delta. So for every dollar move up, you make $1. That's why you'll see a little difference between the P&L of the stock and DITM call. Okay. Now let's look at the best case scenario. You doubled your money. The stock went up double. You'll make almost 16K this side, and you'll make a little bit less over here. But this is the magic of the DITM call. You make almost the same, but remember, you only spent $4,100 to buy this call, and you're making $16,000. Whereas to buy 100 shares of stock, you spent $16K to make $16K. So that's a 100% return. But when you use $4,000 to buy this call and make $16K, there's almost 4 times return of investment. Specifically, it's 380%. That's amazing. Let me recap. You are amplifying your gains by 4 times the amount while reducing your max loss by almost 4 times also. It is truly an amazing and powerful strategy. So let's go through a live example. Say we want to go long on this stock. This is XLV, the ETF. I'm not saying this is a good long. This is purely an example. So what we're going to do is we're going to open up the options chain. We're going to look for the contracts that are expiring in 12 to 14 months. I don't see any 365-day contracts here, so let's just use this 324-day contract as an example. Open it up. We're going to look on the call side, which is the left side, and we're going to look for the in the money options. In the money means we're going to look for the strikes that are below the current price of the stock. So right now, XLV is at 158. So we're going to look at the numbers, the strikes that are below that. As a matter of fact, in Tasty Trade, at the money line, there's actually these small letters that says ITM in the money, and the arrow is pointing upwards. So we're going to look at these. Let's focus on this column, the delta column. We're going to look for the 90 delta contracts. So right here we have the 90 delta contracts, 115 strike. Click on it. Make sure we make it turn green because we're buying this contract. The mid price is about $4,500 per contract. Mind you, this right now it's past 4 p.m. so the market is closed. So don't take these numbers to heart. Okay, this is purely an example. There's also a column called extrinsic value. In Tasty, it's EXT. In Interactive Brokers, it's called time value. You can look at that and you can check how much premium you're paying for this contract. In this case, it's $2.17. So that means we're paying $217 of premium for this contract. So over 324 days, it will cost you $217 to get all of the benefits we talked about earlier. The leverage, the reduced risk, and reduced capital over almost a year. That's less than $1 a day. It's better than that because most of this premium will not decay away. You will not start paying it until later on when it approaches expiry, around the 90-day mark. If you get into this trade and you want to exit maybe in a month or 2 or 3, just a little bit earlier, most of your premiums will still be there. It's not a linear decay. So the cost, you can see right here, theta, it says $1.16 a day. It's actually way less than that. And this is it. It is that simple, and it's a very efficient strategy, guys. I hope you guys can start using this right away tomorrow after watching this video. This is truly a game changer. Once you start using this, you will never buy shares of stocks again. With this powerful strategy, you will reduce your risk and capital usage and also amplify your returns multiple times. If you have any questions, post them in the comments. Trade small, trade safe.